If I told you that the average American will give up over $1 million in interest over their lifetime, not on vacations, not on investments, but simply for privileges of borrowing their own future money, would you believe me? Today I'm going to break down exactly where that interest goes, how the banks win early, and why you lose early, and how the infinite banking concept changes the entire game. This episode might permanently change how you look at mortgages, cars, credit cards, student loans, and business loans. Welcome back to Banking for Legacy podcast. My name is Nelson Pizarro, and this podcast is all about helping families, businesses take control of their own money, stop feeding the banking system unnecessarily, and start building generational wealth the right way. And before we start, make sure you read Becoming Your Own Banker by Nelson Nash. Everything we talk about today is built on that foundation. Enjoy the episode. Let's look at the big picture. Why interest is a silent wealth killer. Most people don't realize this, but interest is front-loaded. That means in the early years of any loan, most of your payment goes to the bank, not the balance. The bank gets paid first, you get equity later, if you survive long enough. And when I mean survive, that just means if you had a mortgage, most people will be in their new homes between 7 to maybe 9 years, and then they go upgrade and go to a bigger house, or they downgrade, which means they start their mortgage all over again. The same thing with a car. They'll buy a car and they'll start making payments for, let's just say their loan goes for 5 years. They buy this car, and after 3 years, they want to get an upgraded car. They go trade it in and get that upgraded car, and now they start their loan payment all over again. So I hope that makes sense there. I'm actually going to break down how this works and how much money we're giving up so that you guys aren't just guessing or I'm just making up numbers. Let's talk about mortgage breakdown. Let's assume that we purchase a home for $600,000, a 30-year loan. You put 10% down. So that loan is going to be around $540,000. You have a 6.5% interest, and your monthly payments are around $3,400. That's principal and interest. Now here's where a lot of times most people lose sight on this just because they want to get into the home, which it's understandable. Years 1 through 10, the payments that were made were $410,000. The principal that was paying it down was $65,000. But here's where the kicker is. The interest that you paid was $345,000. So let me repeat it again. You started off putting about $410,000 for the first 10 years. $65,000 went to principal. $345,000 goes in interest. You paid the bank more than 5 times what you gained in equity. So let that sink in a little bit. Now let's go from year 11 to 20. Your payments made was another $410,000. Your principal paid was $175,000, and now your interest paid is $235,000. So now it's catching up. Your principal is catching up to interest, but it's not even 50-50 yet. And then now your last years, which are nine more years from 21 to 30, the payments were $410,000. Principal is $300,000, and your interest is $110,000. So now let me break all those numbers down and put them all together. So your total over 30 years is $1.2 million. Interest alone was around $690,000. Remember, you bought a home for $600,000. You paid almost $700,000 in interest. So let that sink in, because that's super important that you understand that. We go into the car loan side. Let's just say we buy a vehicle for $50,000. A 6-year loan, 6.5% interest. Our monthly payments are around $840. The total amount that you're going to pay is going to be $60,500, and the interest paid was $10,500. And here's a kicker. Cars depreciate. So you're paying interest on something worth less every single year. Credit cards. The average balance of an American is around 45,000, well, between 39 to 45,000. So we're just going to go on the high end. And let's assume the average APR is 22%. You're paying the minimum payments. Over 20 to 25 years, your interest that you paid would have been between 70 to 90,000 if you did the minimum payments. So the total payment would have been $115,000. Remember, you borrowed $45,000 and you pay back more than double. Let's go on to student loans. Let's just say again, an average is a $45,000 of student loans. 6% interest, 20-year repayment plan. Total amount is $77,000. Interest paid, $32,000. And this is interest on education that may or may not increase your income. Let's talk about business loans. Small business average loans are around $100,000 just to start the business going. They usually start off at 8% roughly on interest, a 10-year term. So you would have paid about $145,000 at the end of the day, or in 10 years. That interest that you paid was $45,000. And the business takes all the risk, but the bank still wins first. So if you went out of business in year 10, you gave up $45,000 just to borrow $100,000, which was almost half. And I get it, you need money to finance. So here's where I come with the whole lifetime interest total average within a family. You got a mortgage, in your lifetime of 30 years, you're gonna pay around $690,000 in interest. We'll talk about cars, around $80,000 in interest, roughly, and that's not multiplying all the cars that we buy within a household. Credit cards, we're gonna say another $80,000. Student loans, $32,000, and business loans, $45,000. So if we add all these up, we're around $927,000 in interest, and that's being conservative. We didn't have any of those hardships that we couldn't pay back any loans and how the balances stack up against you and the interest and the penalties. So if we were very conservative, which we are right there, many families cross over $1 million in interest without even realizing it. So now you're gonna ask me, hey Nelson, what's the alternative? This is what I know. When I need something, I'm gonna go straight to the bank and I'm gonna ask for money, or I'm gonna use the credit card. But how do I get out of all this? Well, you don't stop financing things. You just stop financing them through banks. And what does that mean? Here's what the infinite banking concept does. And I'm going to try to break it down in simple steps. Step number 1, you have to start a policy first. If you have one, great. We can talk about it, we can look it over, and we can see if we can implement the IBC practice in there. But if you don't, here's what it will look like. When you start a policy, you're going to start a whole life policy that pays you dividends, structured for maximum cash value. This becomes your personal banking system. Number 2, build capital. Your money grows inside these policies. Your money compounds uninterrupted. Your money is not tied to market losses. And I'll go back a little bit. It might be maybe 1 to 3% that's tied into the market, but that's very, very little compared to what the insurance company puts their money into. Step 3, borrow against your policy. Use policy loans for down payments, or if you can pay off the house right away, perfect. Cars, credit cards, business investments. You control repayments. Interest goes back to your system, not the bank, which is very important that you understand that. And step number 4, recapture interest. You're still paying interest, but now it's flowing through your family bank, not Wall Street. Now, if this episode opened your eyes, do me a favor. Like, subscribe, share this with somebody who has a mortgage, car payments, student loans, a small business. and follow us on all platforms at Banking for Legacy. If you want to see how this works for your situation, book a free consultation through our own page or give me a call, 619-997-5141. Now remember, I didn't say that banks are evil. They're just better organized than you. Your money, your bank, your legacy. Until next time.